Welcome to Trading Nation. I'm Eric Chemi. It may be earnings season, but one money manager appears to be more worried about the next batch of economic data. Jeff Mills is the Chief Investment Officer at Bryn Mawr Trust. Jeff, welcome to the show.
Hey, Eric, thanks for having me.
Of course, Jeff. So what economic trend is starting to concern you most right now?
Yeah, I think there are a lot of things going on under the surface. I mean, number one, when thinking about market leadership, you look at the trade that's been driving the market higher, and it's been large cap growth. So a lot of those names have been priced for perfection. I think that's being evidenced by earnings. So Tesla, pretty good earnings. Microsoft, pretty good earnings. But all of those stocks have faltered because they haven't ticked every single positive box in the eyes of investors. But when you go over to what's been supporting the market over the past couple of weeks, so the more cyclical areas, small cap, mid cap, industrials, value, they are all now bumping up against that downward sloping 200-day moving average, exactly where they faltered in the beginning of June. So my concern is they're hitting this difficult technical level just at a time where, to your point, some of these economic data points are coming in a little bit soft. So last week, if you look at consumer sentiment as an example, manufacturing PMI was okay today, but services PMI was a little bit below expectations. And then some of the more timely data, just look at TSA traveler throughput. We were growing at a 7% week-on-week growth rate. That is now down to 1%. So as virus concerns has kicked back up, as economies have started closing down again, you're starting to see the economic recovery moderate. And I think that could be difficult for some of those cyclical areas of the market that have been supportive. So at this point, you wonder what's going to take us higher.
You started to touch on what I was going to ask you, which is which S&P areas would get hurt the most by these deteriorating labor market conditions too?
Yeah, I actually think it is the more cyclical areas. Like I said, they're bumping up against that difficult technical level. But if we start to see a material moderation in economic data, and look, we've bounced off the bottom. I think we're past the point where every single data point is going to be ahead of expectations. Now we're just looking to see where things plateau. So I think it is going to be those cyclical areas. And even though the growth areas of the market are expensive, you've seen this divergence in performance. I think investors will probably fall back toward those areas of the market for safety if the economy should falter. The problem is those areas are quite expensive, so I don't know how much gas is left in the tank. So that's why I think probably as we move through the next couple of months, it's going to be more sideways trading, more volatility. So that's likely the order of the day, at least for the foreseeable future, in my view.
Jeff, if people are moving to safety, what does that mean for growth stocks like some of these big tech names?
I think it means they probably catch a little bit of a bid here. They're going to come off the boil. I think as we move through earnings, there may be some disappointments. But ultimately, if the economic recovery moderates, things like value and small cap are going to have a hard time rallying. So people will probably default back to areas that are showing any level of earnings growth. And that's going to be that large cap tech trade. I do feel like there are certain areas, though, outside of tech that could be interesting, at least in the near term. I think about consumer staples as an example. You know, if we do hit a little bit of a rough patch, I think that area of the market will probably hold up a little bit better. It's broken up above the 200-day moving average. I think the dollar probably continues to deteriorate, and staples has the third highest international revenue exposure. And you've also seen massive outflows from staples lately, so a little bit of a contrarian view there. So I think there are other places you can go than just tech, but I do think that major cyclicality in industrials and value and small cap may need to take a little bit of a breather here.
What do you think more long term? Let's say we get a vaccine. Let's say things maybe get a little bit back to normal. Maybe not, right? Maybe long term it's not that great. What do you see is happening, let's say, as we get into next year and the following year?
Look, I think if we can see progress on the medical front and we can get back to normal from an economic standpoint, then I do think it's going to be value in the cyclical areas of the market that do very well. You have this massive valuation discrepancy between those areas and large cap growth. So in a lot of ways, although they may not perform well in the near term, I do think they're spring loaded for when we see an obvious economic recovery. I think those are areas that you want exposure to. So for us, I think I said this last time I was on the show, you just don't want to lean too far in either direction. You want exposure to value. You want exposure to growth. I think you need that, especially in this market where you have these divergences, you have these forks in the road, and we always do, but the end point in these forks is so far apart from one another, and often the determining factor is so binary, vaccine, no vaccine, who ends up in the White House. It's just so hard to predict from where we stand today. It's not exciting, but you need to keep a diversified portfolio with exposure in all of these places, I think, if you want to do well.
Those are a couple of good points, right? You could have a 50 51-49 situation, but it's a very binary outcome that has big effects down the road, depending on all these different forks in the road, the White House, a vaccine. And you're right, no one wants to hear, have a diversified portfolio, but sometimes you got to just take your medicine and just do the right thing there. Jeff, thanks for being on the show with us today.
Thanks, Eric. Appreciate it.
You got it. And of course, before we go, Jeff, I'm just going to bring you back. You still there?
Yeah, I'm here.
Just want to point out,
I'm here.
the music started, but we got to say, the last time you were on, because you mentioned the last time you were on, you said you think the rally was starting to, peter out a little bit, taper off. That was 3,100. We've just barely moved 3% since there, so that was a pretty good call. So people should be paying attention to what you have to say. You've had a good call here in recent times.
So far, so good.
Yeah, so far, so good. Let's see where we are.
I think the choppiness continues. We'll see next time, but I think we're going to be in a very similar place next time we talk.
Exactly. All right, Jeff, thanks for hanging there with us. That was Jeff Mills, Bryn Mawr Trust. Thank you for watching Trading Nation. I'm Eric Chummy. We'll see you next time.